Very good morning, friends. So I hope you're all doing very good. And of course, the obvious assumption, which I always keep saying, that you made your cumulative revisions on all the sessions so far on financial instruments. To remind you what we were discussing, we've now come to Ind AS 109, and our focus is now on the holder's perspective, wherein we started discussing the measurement of financial assets. We're also going to come back to the issuer, looking at the accounting for financial liabilities as well. But for the time being, our focus is on the holder's perspective. How does the accounting, or rather I would say the measurement, to put it technically, as far as financial assets are concerned? To remind you, we decided that financial assets are initially measured at a fair value. With the exceptions, and there are two exceptions, one is a case of trade receivable, and one is a case of loan which is recoverable on demand, which are recorded at a transaction price. Other than these two exceptions, all the financial assets are initially, on initial recognition, taken at a fair value. Then we said, as far as the subsequent measurement is concerned, it depends upon a three-step model, which I'm going to give you today. We're here to discuss that, but we said, based on the three-step model, there are varieties of measurements model which are available. And that's not a matter of choice, which model do you choose? The measurement base is decided on the basis of certain parameters, which we are yet to learn. But we decided the measurement base is either amortized cost, that is called AC. And I gave you the inputs in terms of the concept of EIR, effective interest rate, which is attached to the concept of the amortized cost concept. So we did an illustration. We understood the conceptual inputs with regard to what is the concept of EIR. The other one is called a fair value through P&L, and the other one is a fair value through other comprehensive income. So when you use an amortized cost, we do not capture any fair value. We do not capture any fair value changes. But when you take FVTPL or you take FPT-OCI, you capture the fair value changes at each balance sheet date. And they are either taken in the P&L if it is FPTPL, or it is taken in OCI if it is a case of other comprehensive income. So I gave you some insights about the concept of OCI as well. And I promise that, in the next session, I'm going to just give you a quick recap of the learnings, the important inputs on OCI. So what I'm going to do, I'm going to first give you your inputs. The mind map today is going to be based on the learnings on the concept of other comprehensive income. Getting the insights in terms of what is the concept of OCI, how does it get captured in the other equity? So all the things we're going to pen it down so it'll be very clear on the implications. And why? Because if you want to understand when the financial assets are measured at AC or FPTPL or FPT-OCI, we need to be very clear that what are the implications of these measurement bases on the profits as well as on the earning per share. So what I'm going to do, I'm just going to give you a concrete mind map so that your OCI concept also goes wonderfully well. And then I am going to come back to my chart. So for the time being, we are making a background inputs with regard to Ind AS 109, not exactly discussing 109 at the moment, but giving you some background inputs so that we are very well connected with the logics which are required in terms of financial assets measurement. So today the mind map is going to be on the OCI. So let me put this across. I'm just making a mind map. And for this purpose, the focus is completely on other comprehensive income, that is OCI. So our focus is on the other comprehensive income. So the focus is on the other comprehensive income. So I think to make it easy, there's another very interesting kind of summary which is coming to my mind at this stage. This will very well connect you to the concept as well. So I'm just going to give you slightly different from the way we discussed, because this is a summary chart, a mind map. So let me just, I think, connect you to the inputs. You get the entire insight in terms of OCI. Now imagine this is a container. Imagine this is a container and this is another container. Wow. Now, what I want to emphasize at this stage is this is the traditional profit and loss. This is the traditional profit and loss which you've been making till you can say the CA intermediate stage. Or you can say in a technical terms that this is what is called division 1. This is what you can say is division 1, where you make a profit and loss statement. And when you come to the concept of division 2, when you come to the concept of division 2, the income statement gets divided in terms of two components. One is a profit and loss, and the other is other comprehensive income. Now, why did these standards decide on creating an OCI? That is my emphasis. I'm going to strongly emphasize why the concept of OCI got created. So the next 15-20 minutes is going to be very crucial because I'm making this mind map, but I'm going to spend 15-20 minutes, giving you a complete binding so that our things get strengthened later. So in terms of division 1, we just had a profit and loss. But in terms of division 2, your income statement gets segregated in terms of two sections, the profit and loss and the other comprehensive income. And of course, if you add the two, we get what is called a total comprehensive income. Now, I'm just explaining, what was the evolution of OCI? Why did these standard setters think that other comprehensive income is required to be created? Now imagine when you did your CA intermediate, you did something which is called Accounting Standard 5. Yes, I'm talking of Accounting Standard 5. And if I quote unquote what is written in Accounting Standard 5, in Accounting Standard 5 it says all items of income and expense are taken in the computation of profits. Mind the word. The word which is written in Accounting Standard 5 is that all items of income and expense. The word is very clear, all. That means any income, any expense goes in the calculations of the profits of the company. For example, if I were to take some figures, so we said all incomes, the word very clearly says all incomes, and the word very clearly says in the standard all expenses are taken in the calculations of the profits of the company. So let's assume that the incomes are to the extent of 50 lakhs and the expense is to the extent of, let's say, 30 lakhs. So we can comfortably calculate that what is the profits of the company. So we can say 50 minus 30, the profits of the company is to the extent of 20 lakhs. Now, let's say if I want to calculate the earning per share, the EPS, you know what is EPS. You divide this profit by the number of shares. So let's consider the number of shares, that is number of equity shares of the company is, let's say, 5 lakhs. So if I want to calculate the earning per share, 20 by 5, the earning per share comes to 4. Now, I want to say a few things which are visibly clear at this stage, but I'm going to still say them. You can notice in terms of division number 1 that all items of income and expense is impacting the profits of the company. All items of income and expense is impacting the EPS of the company. So whether it's any income, whether it's any expense, the thumb rule which you can see in this case is that every income and expense is impacting the profits and is also impacting the earning per share of the company. The standard setters, had something in mind. We can understand, we can appreciate that all incomes and expense will impact the profits of the company. Logical. Because assets and liabilities in a trial balance gets captured in the balance sheet. And the income and expense gets captured in the income statement to calculate the profit or loss. So every income and expense has to impact the profits of the company, but every income and expense is also impacting the earning per share of the company. this is what started bothering the standard setters. That why should every income and expense impact the earning per share of the company? So they devised a very interesting concept, dividing the income statement into two portions, the profit and loss and the other comprehensive income. Now, how did they manage? How did they manage to see that every income and expense should not impact the earning per share? So they filtered out. If I just come back on the agenda, that not every income goes in the P&L. Some incomes will go to the P&L and some incomes will go to the OCI. And let me caution you at this stage, what enters the P&L or what enters the OCI is something which is pre-decided. We cannot decide. The companies cannot be taking any kind of decisions that what is filtered in the P&L or what is filtered in the OCI. It's not a matter of their decision. So what enters the profit and loss and what enters the other comprehensive income is a pre-decided list which is given in terms of Ind AS 1. So if you technically ask me what enters the profit and loss and what enters the OCI is a pre-decided list. That this is taken in the P&L and this is taken in the other comprehensive income. So, but let's assume that certain incomes and expense are taken in the P&L and certain income and expense are taken in the other comprehensive income. The reason of filtering this, taking the same figures as a base. So let's say out of this 50 lakhs, let's assume that 30 lakhs enters the P&L and let's assume that 20 lakh enters the OCI, taking the same figure. And similarly, out of the expenses, let's assume that out of this 30 lakhs, or let's, I think, consider slightly changed figures. Let's make this 40 and let's make this 10. So let's say 40 lakhs enters the P&L and let's say 10 lakhs enters the OCI. And let's assume the entire expense of 30 lakhs enters the P&L, nothing enters the OCI. I've just arbitrarily divided, what is entering the P&L or the OCI. But as I said, what goes in the P&L OCI is a pre-decided list in Ind AS 1. Now, if you calculate the profits in the P&L, 40 minus 30, the profits of the profit and loss section is supposed to be 10 lakhs. And if you consider the profits of the OCI, 10 minus 0, the profit of the other comprehensive income is also to the extent of 10 lakhs. And if you add the profits of the P&L and the other comprehensive income, it works out at 20 lakhs, which is exactly the same. So with this example, what I wanted to tell you that they filtered that certain income and expense will go in the calculation of P&L and certain income and expense will enter the OCI. Now, the input which they decided is that when you calculate the earning per share of the company, in this case, what they decided that the OCI doesn't go in the EPS calculation. If I want to calculate the earning per share, we will take the profits of the profit and loss section only divided by the number of shares and you're going to get the earning per share too. So I think one thing which is, absolutely visibly clear, but I want to still put that in words to make it very conceptually strong. The idea of creating the other comprehensive income is that what goes in OCI is got no impact on the earning per share. So they decided that every income and expense should not be impacting the earning per share of the company. So they decided that as far as the EPS is concerned, so their thought process was something which should not impact EPS should be filtered in terms of OCI. Please hear this carefully. Something which is not impacting EPS as a standard setter, I don't want that this should impact the EPS. I'm going to tell the company, let's filter this in the other comprehensive income. And as I said again, that this is not something which is a choice of the company. The companies are not free to decide what they're going to filter in the P&L or OCI. It's a pre-decided list. Ind AS 1 is very clearly given, that in throughout all these standards in the Ind AS, this is the list which is going to be taken in the other comprehensive income. But we need to understand the larger logic. that what kind of items will get filtered in the OCI. But let me, I think, say a few things at this stage. Is every income and expense impacting the profits of the company? Yes. Whether they go in the P&L or OCI? Yes. But is every income and expense impacting the EPS of the company? The answer is no. What goes in the P&L impacts the profits and EPS. What goes in the OCI impacts the profits but not the EPS of the company. Am I crystal clear, friends, at this stage on my thoughts regarding the concept of OCI? Tell me, are we standing absolutely at a common logic now? That what is the basic input of deciding that what is filtered in terms of OCI? Okay, that's great. So one of the main reasons of creating OCI is to give more transparency and reliable data over the financial. Yes, but indirectly, let's put it in simple words, the focus is on the earning per share. Okay, so this gives me one basic learning that what is filtered in the OCI is supposed to be those items which should not impact the EPS of the company. Now, moving forward, I'm just also going to add another inputs at this stage. So if I want to pen down my learning so far, though we are going to make some changes, of course, on this learning, but this is like a version 1 of the learning. I would say this is like, the version 1 in terms of learning. So we're looking at that, okay, so far, whatever we have learned, if I want to, just document this bit. So what we've decided is the 2 inputs so far. So I'm putting this in a summary chart. So far, and this is the version 1 of our learning. This is the version number 1 of my learning in terms of profit and loss and in terms of other comprehensive income. So I think let me put some quick questions. So we stand absolutely clear on the learning so far, then we go to the version number 2 to develop further. So I want to see that when you take things in the profit and loss or OCI, does it impact the profits of the company? That's 1. Does it impact the earning per share of the company? That's 2. Let's put the questions to you now. So when you put something in the P&L, does it impact the profits and the EPS? Yes or no? You put the income and expense in the P&L, so does it impact the profits and the earning per share of the company? And I think undoubtedly we get the answer yes. That's absolutely correct. So there is going to be impact on the profits and there is going to be impact on the EPS. But when you put something in the OCI, does it impact the profits? Yes. What about the EPS? Yes or no? So it definitely impacts the profits because it is a part of the total comprehensive income. And what about the EPS? Is there any impact on the earning per share? And that's right, it's no. It's no. So what comes to my mind at this particular stage is, let's develop a framework to begin with. Let's develop a logical framework to begin with, that what items should be taken in the P&L and what items should be taken in the other comprehensive income. Though what I'm about to tell you is got a lot of exceptions in the standard. But to your learning so far in terms of Index 16 or in terms of Index 38, you would have witnessed that there is a certain basic concept which goes in deciding what is to be filtered in the OCI. Let's put it like this. As a standard setter, when I feel that this should impact the EPS, I'll tell the companies to put it in the P&L. As a standard setter, when I feel that this should not impact the EPS, then I'm going to say, okay, let's put it in the OCI. So I think we are going to use this concept. As a standard setter, let me decide, okay, this should impact the EPS. I'll say P&L. This should not impact the EPS. I'm going to say OCI. So I'm going to say 4 things to you, and you decide whether it should get into the P&L or the OCI. As I say the items, you need to filter that if this impacts EPS, tell me P&L. If you feel this should not impact EPS, tell me OCI. So let's give you 4 inputs on this case and you decide. If there is a realized gain or a realized loss, what do you think? It should impact EPS? Should it be taken to the P&L or the OCI? I'm talking of realized gains and realized loss. So that's rightly said. Yes, makes sense to me. So I would say, in terms of the profit and loss to begin with, in terms of the profit and loss to begin with, we can say if there is any realized gain, if there is any realized gain, or if there is a realized loss, let's take it into the P&L. Let the EPS get affected. But let's say there is an unrealized gain, then do you think it should affect the earning per share of the company? Or we should put it in the OCI so the EPS is not affected in this case? So I would say, in terms of OCI, if there is any kind of unrealized gain, if there is any kind of unrealized gain, that will also enter the other comprehensive income. But what about the unrealized loss? My accounting works on the concept that we take into account prospective losses, but not prospective gains. If that be the case, that you consider the prospective losses, should the unrealized loss be taken in the P&L or should it be taken in OCI? Let's get this from you. So what do you say? If you've got unrealized losses, should that be put in the profit and loss? Or we should put this in the profit and loss, or in which place do we put? I think that makes good sense to me. That it should be taken in the profit and loss account makes complete sense. So if there is going to be an unrealized loss, I'm going to put this in the profit and loss. But let me, I think, put this point blank at this stage. Let me put this point blank at this stage that, this is got. So there are a lot of exceptions coming in. There are a lot of exceptions which are coming in based on the other standards as well. So what we said so far is just the basic version number one. Is the basic version number one, but there are a lot of exceptions coming in. So for the time being, of course, I can apply things in the mind that, okay, if you tell me there is a realized gain or loss, or there is unrealized loss, let's park it in the P&L. So the EPS is impacted. But if there is unrealized gain, let's put it in the other comprehensive income. Wow. I hope, friends, I'm 100% clear on my version number one. That what is filtered in the P&L and what is filtered in the other comprehensive income. Now comes the version number two. So there are going to be, sir, how many versions? 3 versions. 2 versions I'm going to give you today. And the third version comes later, much later, almost towards the end of financial instruments, not today. So I'm going to give you 3 versions in all. The second version is going to be helpful, but ultimately the version 3 in terms of OCI and in terms of SOKI, you get that later. Now let's go to the version number 2. We are working on the second version at this stage now. I am working on the version number 2. I'm working on the version number 2 in terms of other comprehensive income. That was the basic version. Filtering what goes in the P&L and filtering what goes in the other comprehensive income. But there is now a second version. And the second version is the concept of R and NR. Now that's crucial. So when you look at the second version, the other comprehensive income has been segregated in terms of 2 parts. Put it like this. If you want to put it like this in form of a container, for example. So I would say the concept of other comprehensive income is that it's been further divided in terms of 2 components. It's been further divided in terms of 2 components. So when you take other comprehensive income, it is R as well as NR. It's been divided in terms of 2 subsections again. So you can say the profit and loss, the income statement is P&L, OCI, R, NR. There are 3 containers actually. There are 3 containers actually. Some income and expense enters the P&L. Some income and expense enters the OCI R. Some income and expense enters the OCI NR. So what is this R and NR? So when you say R, it is supposed to be, you can say reclassification. It is called reclassification, or you could call it as recycling. And when you say it is NR, it is supposed to be a case of no reclassification. Or you can say no recycling. Let's call it as reclassification and no recycling. I always tell people some weird examples to understand the concept of OCIR as well as OCINR. In this particular case, I used to take an example based on a COVID situation, but I think it's been quite some time, so let's not get into COVID, where I used to tell people, that there are three kinds of people. One who got a vaccination done, one who got only one dosage of vaccination done, and the other who did not get a vaccination done. Now, I'm just looking at the fact that, I would say there are three kinds of parenting which can be done. So one kind of parenting is that if a child does something wrong, you beat him then and then. The second kind of parenting is that, you only beat him when the need arises. And the third kind can be don't touch him ever, don't touch him ever. Of course, the third kind of parenting is what is followed these days. But, over a period of time, we've seen evolution in terms of parenting. So one is that, anything goes wrong, you beat him. The second is that you beat him only when the need arises, not at this stage. And the third is don't tell him, only explain, don't ever touch him. So you're going to see that kind of inputs coming in OCI as well. Now watch this. So in order to give you this concept of R and NR, what I am now going to do, I'm going to make an income statement. I'm just making a dummy income statement at this stage. This is a dummy income statement, and I'm also making a statement of changes in equity. I'm also making a statement of changes in equity. So watch this carefully, because this version 2 is going to give us more deeper understanding of the concept. So I'm looking at the extract. I'm looking at the extract in terms of income statement. And I'm looking at the extract in terms of statement of changes in equity. So this is tab 1, this is tab 2, and this is tab number 3. This is year 1, this is year 2, and this is year 3. This is the profit and loss. This is OCI, which is segregated in terms of R as well as NR. Now watch this very carefully. Watch this very carefully in terms of R as well as NR. Now, let's consider, as per the instructions in the standard, you put something in OCI NR. So I'll take a different color once I come to R. So let's say you put that 4 lakhs in the NR. So this will get accumulated in tab 3. When you put something in OCI NR, it is accumulated in the tab number 3. It is accumulated in the tab number 3. And let's say in the next year, you put another 3 lakhs in the OCI NR. So it gets accumulated again in the tab number 3. It gets accumulated again in the tab number 3. So whatever is taken in the OCI keeps getting accumulated in the tab number 3. Now, once you sell a given asset, for example, if you're looking at a PPE, that is India 16, and you made a sale of the asset, let's say the profit on sale is to the extent of 2 lakhs, and this realized gain is taken in terms of tab 2. So what goes in the P&L accumulates in tab 2, what goes in OCI accumulates in tab 3. Now we're understanding OCI NR. We're understanding OCI NR. Now, in terms of the OCI NR, you will definitely vouch me. This amount is now realized. And if this is realized, I'll reduce the money from this tab and simply transfer it out here. Simply transfer it to the tab number 2. This is called no reclassification. This is called no reclassification. Now, you need to understand the implications of this. That's important to understand the implications of this. This 7 lakh is being an internal movement within the SOKI. It's shifting the money from tab number 3 to tab number 2 because now it becomes available to pay dividends. So the thought is, when you put something in the OCI, don't worry, I'll pen it down. When you put something in the OCI, the profits are impacted? Yes. The EPS is impacted? No. It accumulates in the tab number 3 and then it shifts to the tab number 2 on the realization. Now, the interesting part is this 4 lakhs and 3 lakhs impacting the EPS of year 1 and 2? No. Is this the same 7 lakhs which is internally shifted within SOKI? Yes. Did it impact the earning per share? No. I want to now put the question to you. When you put something in OCI NR, do you think the EPS is ever affected? Or can I say that is the third kind of parenting where you never ever let the earning per share get affected. You park something in OCI NR, it does not impact the EPS of year 1 and 2. Even when it gets realized, it is taken and shifted within the SOKI, it still does not affect the earning per share. Is my thoughts correct? So putting things in OCI NR means that the earning per share is never ever affected. Is my thought absolutely clear? Vouch me, friends, on that. Is my thoughts absolutely clear that yes, that is right? If you put something out here. So I think that is something which is taken in mind while creating the concept of OCI and these standards. Yes, of course, EPS is the main, I would say, criteria of thoughts. So this is as far as the concept of OCI NR is concerned. Let me now change the color. Let me now change the color and move with the concept of OCI R. So I think let me just create a separate OCI SOKI so that there is no confusion. So we'll take this in terms of P&L with a different color, but let's, I think, take the SOKI separately. So this is my tab 1, this is my tab 2, and this is tab 3. Now let's say something in the blue color. Now let's say this is 4 lakhs in the OCI R. It gets accumulated in tab 3. Whether it is OCI R and R, it gets accumulated in tab 3. Remember, you put it in the OCI R and R, irrespective, it goes in tab 3. Then you put this 3 lakhs in OCI R, it still gets accumulated in the tab number 3. So this total works out at 7 lakhs. And let's say the realized gain, you put it out here, that is 2 lakhs. Now, what is the concept of OCI R? Reclassification. The day this money gets realized, what we're going to do, the accumulated balance in tab 3 is supposed to be reclassified and put in the profit and loss account. The amount which is there in the tab number 3 is reclassified and put in the profit and loss account. Now you can see something very interesting happening. Automatically, the sum total of this 2 plus 7, the sum total of this will automatically enter the tab number 2. So it doesn't go directly in tab 2. It doesn't go directly in tab number 2. It gets reclassified in the P&L and then it comes to the tab number 2. So in case of NR, it's a direct shifting. But in terms of R, it is not a direct shifting. It gets into the P&L of the current year and then comes back in the tab number 2. So moral of the story, did this 4 and 3 lakhs impact the EPS of the current year? No. But isn't this the same 7 lakhs entering the third year P&L? Yes. This is, I would say the second kind of parenting that, when the need arises, you hit upon the EPS. The earning per share was not impacted in the initial years, but the earning per share got impacted in the third year. So when you put something in OCI NR, EPS is never ever affected, neither on unrealized, neither on realized. But when you put it in OCI R, the EPS is not affected when it is unrealized, but it gets affected when it gets realized. Did you get my point? I hope I'm very clear, crystal clear on my thoughts. So when you consider the concept of OCI, in my version 1, I was only talking of OCI impacting EPS or not. In my version 2, I went ahead And I told you that in terms of OCIR and R, so in terms of OCIR, EPS is never ever affected. Unrealized also, no impact. Realized also, no impact. But in terms of OCIR, when you put it in the P&L, when it is unrealized in OCI, EPS no impact. But later the EPS gets affected on realization. That is the concept which is called, you can say, OCIR. Sir, are there exceptions to this particular version as well? Yes. So if you ask me that are there any exceptions to the version number 2? Yes, there are exceptions to version number 2 as well. That's what we're going to call the version 3, which I can't give you at this stage. So it's not logical to say that, if it is unrealized, it goes in OCI, and the day it's get realized, it goes in P&L. That's a basic version. There are exceptions also to this particular concept. Wow. I think now it's time to pen down some thoughts at this stage based on the learnings in terms of the version number 2. So I'm going to just give you the inputs based on the version number 2. Let's make a summary chart based on this. Rather, let's do one thing. On this particular version, let's look at 3 impacts. If you can answer this, if you can get the chart filled, I think your fundas are going great. I know I've spent a good time on this, but unless you spend time on this, you'll never get the conceptual clarity. You'll never be able to understand the logics in terms of financial instruments. So let's put it like this. Let's put this as a summary chart. The learnings which are based on the version number 2, the summary chart on the version number 2. So there will be a version number 3 also coming in, which is going to incorporate the exceptions as well. Today, I have not done any incorporation of exceptions in version 1 and 2. The version 1 is giving you the basic fund of OCI. I don't want the EPS to be affected. And the version number 2 tells you, I want the EPS never ever to be affected. I want the EPS always to be, to be affected later. Now let's give you 3 sentences. I've been doing a lot of talking since morning. Now it's time to give you some inputs and get some vouching done from you. So I'm considering profit and loss. I'm considering OCIR, and I'm considering OCI-NR. I'm going to give you 3 inputs, and you tell me where do we filter them. As a standard setter, I want the EPS to be affected right now. As a standard setter, I'm interested in your EPS to be affected right now. Are you going to put this in the P&L or the R or the NR? Let's get the answers from your side. Let's see the conceptual clarity you've attained so far on this. Okay, so I think I get the answer P&L. That's wonderful indeed. I get the answer P&L. That's wonderful indeed. So absolutely correct. Makes sense to me that I'm going to put this in the P&L. Superb. My next question. I want that it should never ever affect the EPS. Not now, not later, never ever. OCIR and R. I want the earning per share to be never ever affected in life. So I'm going to put this filter in OCI and R. Superb. And if I want that the EPS should be affected not now but later, then undoubtedly it is OCIR. Superb. So which means as a standard setter, let me put it like this, as a standard setter, if I want that the EPS gets impacted immediately, the EPS gets impacted right now, the EPS gets impacted right now, I'll say, okay, let's put this in the P&L. I want the earning per share to be impacted right away. Tuck, tuck, tuck. The child does something wrong, tuck, tuck, tuck. And if I want the EPS never ever to be affected, EPS never ever to be impacted. So this means the third kind of parenting, I'll never hit the child. I'll never ever hit the child. Sorry, that's going to be NR. I'm afraid I need to change the headings. That is NR. I don't want the EPS to be ever affected in life, ever affected in life. And if I want that EPS gets affected EPS gets impacted later. EPS gets impacted later and not now. It gets impacted later, but not now at this stage. Then it is OCIR. Remember these crucial points. So the standard set is a very clear-cut thought, but as I said, I think I'll now like to put this across out here that, this has got a lot of exceptions coming in later. So this has got a lot of exceptions coming in later, which will get incorporated in the version number 3. Aha. I'm sure, friends, now you're getting a good clarity. I'll take your scores after the end of my discussions, because that's important to get the clarity of thoughts in terms of what role does a P&L or OCIR or OCINR plays in terms of the income statement. So I think now let me also do one more thing at this particular stage. So I think just to put the things in the right order, we can say that if I look at the impact, on the profits and the impact on the EPS when it is unrealized, and I also want to look at the impact in terms of profits and the EPS when it gets realized. So I think it's good to see that what will be the impact on the earning per share and the impact on the EPS when it is realized or unrealized in nature. Now let's pen this down. When you put something into the P&L, you can say the impact is right now. So I'm not filling this column, I'm just leaving it blank, because the EPS and the profits will get immediately affected. So my focus is not on P&L. I will now look at OCIR and R. Now let's see. Can I say when it is unrealized, is it impacting the profits, OCI and R? Yes or no? When it is put in the OCI, when it is unrealized, does it impact the profits of the company at that stage? Yes. Does it impact the EPS? No. Now tell me, when it gets realized, I'm looking at the same profit getting realized, not another one. When the unrealized profit is put in the OCI, accumulated in SOKI, does it go again in the P&L? No. So can I say when it gets realized, does it impact the profits? No. Does it impact the EPS? No. So here is what I want to show you. That the EPS is never ever impacted. What goes in the OCI NR section, accumulated in the tab number 3, never ever goes to the P&L again in life. So when it was unrealized, it was put in OCI, and even on realization, it doesn't go to the P&L. Now, let's look at the other one. When you say OCIR, does it impact the profits? Yes. Does it impact the earning per share? No. Now tell me, does it impact the profits again? Now that's a crucial question. When you put something in OCIR when it is unrealized and it gets realized, does it impact the profits again? The profits of year 1 and 2 were impacted. The third year profit on realization, will it again be impacted? Because in the second year, it enters the OCI, part of the total comprehensive income. In third year, it enters the P&L, part of the other comprehensive total income again. Yes. So the profits get impacted twice. You can see the profits get impacted twice. On unrealization in OCI, on realization it is in P&L. And does the EPS get affected later? Yes. Now you can see this chain as well. That the EPS gets impacted later and not now at this stage. So I've given you the two versions now. You need to be very clear that when you put things in the P&L, profit, EPS, tuck, right now. OCINR, never. OCIR, not now, later. So you need to keep this in mind. EPS impact, P&L, right now. OCIR, not now, later. OCINR, never, ever. Now let's get your scores on comfort, friends. We've spent a good time on the concept of understanding the concept of OCI. I'm going to come back to 109. Because I need all this inputs extensively. But first, let's get to comfort zones. on the understanding of the version number 2 so far. The third version will come later. Your scores on a score of 10. Let's get your comfort zones at this stage. So I got the inputs at this stage 9.5, 10 out of 10. That's wonderful indeed. And 10 out of 10. And that's great. That's superb. Wonderful indeed. So I think I got a good scores 9.5, 10, almost 10 out of 10 majority. Superb. Now let's come back on the journey. So that was my mind map giving you a revision, which I said, because I think last time you may not have been able to connect the dots too clearly, but I think with a fresh mind, we're able to connect the dots very carefully. Okay, now let's move further. Now let's move further on this. I'm coming back now on my financial assets accounting. We've done the concept of amortized cost. Now, before I give you a three-step model, I want to first of all get the parameters. I want to get the basic parameters. That is when to use amortized cost, or when to use an FVTPL, or when to use an FVTOCI. Remember, when I developed things from the issuer perspective, I took you to the risk perception. When I gave you the three-step model from the issuer point of view, I said, if the risk is not there, that is, issuer has got no risk equity, the issuer has got risk financial liability, the risk is getting divided FL and equity CFI. Here again, from the holder's perspective, to my mind, the concept of which measurement base would apply to the financial assets is somewhere related to the concept of risk. Now, let's get some basic parameters done. So I'm going to give you some basic parameters to decide when do we use these particular models. Now, we are just going to develop some basic inputs at this stage. I want you to decide something based on this. To my mind, the standard setters had one very interesting inputs in the mind, and for which they conducted, they had also had certain risk assessment test. Which model is going to be chosen in which case is based on certain risk assessment tests. Now, what are those risk assessment tests? We'll see later. But let me, give you the basic thought. As a standard setter, if I assess, how will I assess will be seen later. Please hear me very carefully. As a standard setter, if I assess, how will I assess the risk is going to be discussed later. But if I assess the company has taken no risk, I'll decide a particular measurement base. If I decide the company has taken a huge risk, I will decide a different measurement base. And if I decide the company has taken it moderately, somewhere in between, I'll take a different measurement base. So my measurement base is going to be based on a risk assessment. My measurement base is going to be based on a risk assessment. If I assess the risk is not there, I'll give them a different base. If I decide the risk is very high, a different base. And if I see it's moderately in between, then a different measurement base. Now, how would I decide the risk is less or more? That will be seen later. But before that, I'm taking P&L, I'm taking OCI, that is, let's not take OCI or another at this stage. Let's take AC, let's take OCI, and let's take P&L. Now, fair value changes. In terms of cost approach, do you capture the fair value change? No. In terms of OCI and in terms of FVTPL, because this is FVTOCI and this is FVTPL. So are you going to capture the fair value changes? Yes, the fair value changes goes in OCI, the fair value changes goes in P&L. And if you consider the fair value changes, I want to see that what is the impact on the profits and what is the impact on the EPS. If you don't capture the fair value changes, If you don't capture the fair value changes, there is no impact on the profits and EPS. There is no impact on the profit EPS because you did not capture them. If you take them in the OCI, it impacts the profits but not EPS. If you take them in the P&L, both are impacted. Please see this carefully. Please see this chart carefully, what I've done till this stage. I've given you the inputs in terms of fair value changes being captured and the impact of those fair value changes on the profits and EPS. Now, let me ask you something, friends. Look at this chart carefully. Which one do you think the company will feel scary? Out of all these three, which one do you feel is scary for the company? Amortized cost, fair value through P&L, or OCI? Which one do you think the company will scare? Imagine if I take the fair value changes in the P&L, your profits and EPS is ECG report. The fair value goes up, the profit EPS goes up, otherwise it goes down. So which one do you think the company will fear? If I tell them to use a particular approach, which one do you think they will fear in terms of using? Because in terms of P&L, your profits EPS will keep fluctuating because every fair value change will impact the profits and the earning per share. Do you think they'll fear them the highest? So what do you say? Which category do you think they're going to fear readily? That this is dangerous indeed. This is dangerous indeed. What do you say? I'll just come back to you, Manish. Just give me a minute. So can I say in this particular case, if I have to decide which category is the most dangerous, if I want to decide which category is most dangerous, can I say this is going to be highly dangerous in nature? So if a company takes a high risk, I'll tell them, boss, I want to convert your profits and your EPS into ECG report. You're using public money to make investments. So when you create financial assets which are highly risky in nature, it's going to be FVTPL. I'll say if the fair value goes up, your profits EPS up. The fair value goes down, your profit EPS down. Which category do you think the company will love? I think they'll love the category of amortized cost in this case. So can I say if you find that there is no risk, I'm going to use amortized cost. How would you assess the risk is high or no risk? It will be seen later. But the standard setters had something in mind. When you see the risk is very high, tell them that you're going to use FVTPL. I want to see the fluctuations of fair value changes on your profit impact, on your EPS impact. If they do not take any risk, I'll say you're safe. I will never touch your profits, so EPS profits, no impact. And if you're somewhere in between, the two scales, the risk is not high, the risk is not zero, but in between, I'll say, okay, I'm going to put this in OCI. Let the profits be impacted, but not the EPS. This is my thought process in terms of deciding when to use these three parameters. The standard gave us some risk assessment parameters on the basis of which I will decide. How do I assess a risk is what we're going to see later. But on the assessment of the risk, if my assessment tells me no risk, AC, high risk, FVTPL, midway in between, FVT OCI. Okay, I think, yes, Manish, you've got a doubt. Yes, please go ahead, beta. You want to use a mic or you want to type it out? If you want to type it out or you want to use a mic, Manish? Okay, OCI 2 times impact to the P&L. OCI R impacts EPS. Okay. You see, yes, you're right. If you just go back to the chart, I just made that mention as well. When you put it in the OCI R, the profit gets impacted once. Because you put it in the OCI when it is unrealized, but not in the P&L when it gets realized. But in terms of OCI-R, the profit gets impacted twice because you put it in the OCI when it is unrealized, part of the total comprehensive income. and it gets in the P&L when it is realized. That's also part of the total comprehensive income. The total profits of the company is P&L plus OCI. So when you put it in the OCI, when it is unrealized, it impacts the total income. When you put it in the P&L when it's realized, it again impacts the total income. So you can say the profits are getting impacted twice in this case. Is it right? Yes, but you need to remember that OCI is just, one temporary parking space in life that doesn't even get into the calculations of EPS. So literally speaking, if you want to identify what is the profits of the company, I would say it is the profits of the P&L section. Just on the namesake, you would say that the profits of P&L plus OCI is a total profits, but technically what is my profits? P&L. So on the namesake, it is a part of the total income, but it went to OCI. And in this case, now it really went to the P&L. So, I always tell people that when you read the financial statements of a company and there is OCI, what is a good need of looking at the incomes in OCI? That is not the real earnings, because what is taken in the OCI is again put temporarily in tab number 3, and then on the realization, it enters the tab number 2. So it's just, putting them in a temporary parking space. And putting them in a temporary parking space doesn't really have any impacts on the profits and EPS per se. Did you get the logic? Right? So this is a beautiful accounting introduced in the Indias, because this doesn't happen in terms of accounting standards, where we just got one concept of P&L, every income and expense and the profit and loss, and that's the end of it. But in this case, you can see things are very scientific. When they're unrealized, it gets parked somewhere else. When it gets realized, it gets parked somewhere else. And accordingly, we keep changing the places where it has been put and parked in the financials. Correct? You're welcome. Okay, so this is done. Now we are ready with this inputs to come back to the inputs. Now we will work on a 3-step model. We're going to work on a 3-step model, which is based on the subsequent measurement FA. So I'm back to the chart just to remind you. Financial assets initial measurement is fair value. Subsequent depends upon the parameters 3-step model AC, OCI, P&L. When will I use AC? No risk. When will I use P&L? High risk. When will I use OCI? In between. Zero risk and high risk, anywhere in between, it is OCI. Now, let's, I think, begin the journey. Now, for the time being, what I need to do, I am also carrying the chart, which is the interesting chart in the study material. So that you know that we are working on this chart, let me, I think, share the inputs out here. Wow. I'm just going to crop this so that you can see this. We're going to come back to this chart again later. But I just want you to first have a little look at this chart. I think it's a wonderful chart. We are working on this particular chart. Let me know, friends, if that is visible to you. I think yes. So look at this particular chart. We're going to convert all this into a 3-step model. We're going to convert this into a 3-step model step by step. So don't get scared at this. It's going to take us time, but I'm going to give you logics based on this chart. So it's almost like, I would say, around 8 in the morning. So I think by the end of almost like around 9:15, 9:30, you will be 100% conceptually clear on this particular chart. Then we'll start working on the practical illustrations on this as well. Wow. Let's have a look. So I think I am, first of all, looking at something called debt investments, not derivative at the moment, and equity investments. Now, please hear me carefully, friends. I'll document things later. Don't worry. I'll document things later, but you need to hear me carefully. I'm first going to give you my inputs on the 3-step model so that you understand what is going at the back of my mind. I'll first of all give you the insights in terms of how the thought process is done. So we are working on subsequent. We're working on the subsequent measurement. We're working on the subsequent measurement of financial assets. And I'm giving you a 3-step model. We're working on this. And for this, I'm going to give you a three-step model. Let's first of all give you the basic structure of how you are going to think. So please hear me very carefully. Every word is now going to be important if you want to get the logics. Step number 1, step number 2, and step number 3. So I'm looking at the 3 steps with which I will decide the measurement of financial assets subsequently. Just hear me, and you might find this very funny what I'm saying, but you need to understand and appreciate this very well. Let's consider an example of a financial asset where I invested into the equity shares or debentures of another company. For understanding, let's consider an example of a financial asset that my company invested in equity shares or debentures of another company. I remember asking people just for the sake of understanding. As an investor, will I go to the issuer? Will I go to the issuer and tell him, is it a financial liability for you? Is it an equity instrument for you? Or is it a compound financial instrument so that I can decide my category? What do you say? As a holder, when I invested into the equity shares or debentures of another company, am I going to go to them and tell them, sir, how do you show this in your balance sheet? Is it FL for you? Is it equity for you? Or is it a CFI for you? And then accordingly, I decide, is that question valid? Do you think it makes sense that I put that question to the issuer? How do you present the instrument at your angle? And I get the answer, no, sir. How does that make a sense? But the answer is a big yes. I am not going to literally go to the issuer. I'm not going to literally go to the issuer. But first of all, the standard wants me to step into the shoes. It wants me to step into the shoes of issuer. Now, this is a very crucial and important input in step 1. When as a holder, I invested in another company, I am supposed to step into the shoes of the issuer. Please mind this carefully. So I will say from the issuer point of view, if it is FL, then it becomes a debt investments for me. If it is equity instrument, it becomes an equity investments for me. And if it is a CFI, then also it becomes a debt investment for me as a holder. Earlier what we said earlier, the issuer says FL, the holder says FA. The issuer says equity, the holder says FA. The issuer says CFI, the holder says FA. Now we're going to go to the next level. We just can't stop at calling it as a financial asset. So I need to step into the shoes of the issuer and identify if the issuer says it's an FL, it's a debt investment for me. If he says it is CFI, it's a debt investment for me. If he says it is equity instrument, it is equity investments. So deciding this category is important. For this, I'm not going to literally go to the issuer and ask him, but I'm going to read the instrument as if I am the issuer also. I will look into the agreement with the eye of an issuer and decide that, okay, is this FL? Then it is debt investments. If it is CFI, then it is debt investment. If it is equity instrument, it is equity investment. Did you get the step 1? Did you get my step number 1? Looking into the agreement from the eyes of the issuer is something which the holder is required to do in terms of step number 1. Now, I think if I just take you back, you'll correlate this with the chart as well. You'll easily correlate this with the chart as well. See. So when we are saying it's a debt investment, when I'm saying it is supposed to be a debt investment, that means if you look at from the issuer point of view, it is supposed to be either a financial liability or it is supposed to be a CFI. And when you say it is an equity investment, from the issuer point of view, it is supposed to be an equity instrument. That is the step 1. That is the step 1. Many people don't do that. But that's conceptually not correct. The standard is requiring you to step into the shoes of the issuer to see that you invested in equity instrument, equity investments. You invested in FL and CFI, that's debt investment. So when you go to read a question, your first focus will be to see that, okay, if I start looking at the issuer point of view, is it FL, equity, or CFI? Accordingly, I decide debt investments, equity investments. Let's come back. Now, once you've decided that in terms of step number one, let's give you the next thought process. Now, in this particular case, in the next thought process is, I am going to do in both these steps a risk assessment. In both these steps, I'm going to do a risk assessment. In step 2 also, I'll do a risk assessment. And in step 3 also, I'll do a risk assessment. Now, how do I do a risk assessment? We'll see. But if this risk assessment gives me a conclusion that there is, you apply the risk assessment test in step number 2 and 3, and you reach a conclusion that there is no risk, which measure that there is a high risk, then which particular base are you going to use? Can I say FVTPL? That's right. We're going to use FVTPL because we say the risk is very high in that case. And if you say it is somewhere in between, then which measurement base are you going to use? I hope you got the structure very clear. My 3-step model is going to be based on a systematic movement. I will first step into the shoes of the issuer and decide, is it debt equity investments for me? In step 2 and 3, I'm going to do a risk assessment, and based on that, the conclusions will decide, is it AC, is it OCI, or is it P&L? Now, in terms of the step number 2, when you do a risk assessment, I am going to put a question to the issuer. In the step number 3, I'm going to put a question to the holder. In order to make a risk assessment, I'm going to put a question to the issuer in step number 2, and I'm going to put a question to the holder in terms of step number 3. So in order to make a risk assessment, remember, the question is put across to whom? And when you're going to do this in step number 2, I will decide in step number 2 only 2 things. Is the risk there or not? I'll only decide the presence or the absence of the risk, nothing else. In step number 2, by putting the questions to the issuer, I will only decide the risk is there or the risk is not there, nothing else. In step number 3, when you put a question to the holder, I will decide. If you said that there is no risk, I will reconfirm. That, okay, there is no risk. And if you say there is a risk, if you said in step number 2 there is a risk, I will decide, is the risk high or is the risk less? So let's get the structure very clear. This is completely understanding the 3-step model essence. So let me put the thoughts to you. When we go to apply the 3-step model, so what we need to do, go step by step. First, as a holder, I will step into the shoes of the issuer. And I will say, okay, your FL, my debt, your CFI, my debt, your equity, my equity investments. I need to decide, is it debt equity investments? Step into the shoes of the issuer. That's it. Deciding the category is the step number 1. The step number 2 is risk assessment, putting a question to the issuer. The step number 3 is risk assessment, putting a question to the holder. So in step number 2, you need to put a question to the issuer to make a risk assessment. And in step number 3, you're going to put a question to the holder to decide a risk assessment. In step number 2, you will decide risk is there or not. That's it. The presence or the absence of the risk. That's it. In step number 3, you're going to decide, okay, there is no risk. Let me reconfirm that there is no risk. And if there is a risk, let me decide, is it high or low? When you decide that there is no risk, AC. When you decide that there is high risk, FPTPL. When you decide there is a risk in between, FPTOCI. Did you get my fundas clear? Is my thought process on the three-step model clear? Then we can proceed. Then we can proceed. So any questions coming to your mind, friends, so far? Am I absolutely clear on my thought process on my three steps? Yes, full clear. That's wonderful indeed. Now, friends, since I am standing out here in front of the camera, so in order to make visualizations, what I'm going to do, when I'm going to speak to the issuer, you have to imagine I'm speaking to the issuer on that side. When I'm going to look at that side, I'm going to speak to the holder. So as I speak, you need to visualize my talking as well. I'm going to look at that side to speak to the issuer in step number 2. I'm going to look at that side to speak to the holder in this particular case. So as I speak, you need to see the dialect deliveries going on, so that you're able to visualize better in terms of what I'm saying. Let's go ahead. I'm going to make 3 charts now. I'm going to make 3 charts now. Chart number 1, where I'm going to consider equity investments. Chart number 2, where I'm going to make a debt investments when you invest in FL. Chart number 3, debt investments when you put money in CFI. Aha! 3 steps, 3 charts. I think there also in issuer I gave you 3 steps and 3 charts. You know, when you're going to do your cumulative revisions, you're going to see everything is built chronologically, order. Okay, let's begin. So I'm going to start with the first input, and this is my chart number 1. This is my chart number 1. So we're working on the chart number 1. So on this chart number 1, I am looking at equity investments. In the chart number 1, I'm looking at equity investments. So watch this carefully, because the chart number 1 is very simple and you need to hear every word carefully. Okay, let's make a chart. I'm going to put questions across to you. So we are making 3 steps to understand the build. Step 1, step 2, step 3, and then decide the base. So this is my step number 1. This is my step number 2. And this is my step number 3. And on this basis, we will decide what is the measurement base. So we will decide based on this, what is the measurement base. Okay, let's begin the journey. I'm going to now put questions to you, and you have to decide chronologically with me. I have invested, so I'm being a holder for the time being, though I'll speak to the holder later. So let's say a company invested in equity shares of another company. So I looked at the agreement from the issuer perspective. It is equity instrument. What is it for me? For the holder. So as a holder, let's say I invested in equity shares of another company. So when I looked into the shoes of the issuer, I said it is equity instrument. So what is it for the holder? So tell me, what does it become for the holder? And that's right, it becomes a case of equity investment. Great. So when I step into the shoes of the issuer, I said it is equity instrument. So I said from the holder's point of view, it becomes a case of equity investments. And that's the reason I've written equity investments, that you made an investment in the equity instruments of another company. Now, let's speak to the other person. Now watch my discussion with the issuer. I'm speaking to the issuer. Please watch my discussions. Then I'm going to give you technical wordings later. I'm speaking to the issuer. I asked him 2 questions. Number 1, are you going to pay me any dividends during the lifetime? He says discretionary. I said, okay, that means even if you earn profits, you may decide not to pay me dividends, right? He says, yes, sir. I've got a complete discretions. I may not pay you any dividends. Okay. I said, okay, are you going to give me my principal money back? He tells me that you're going to get this money on liquidation, and that also when you stand last in the queue after everybody is paid, if there is any money, I'll give it to you. Oh my God. I put the money in a company where he's telling me returns discretionary, principal given on liquidation, and that also you stand last in the queue. And if there is anything left over, I give you the money. Are you feeling a risk is there or not? By getting the understanding of the return in the form of dividends and by getting an understanding of the principal repayment from the issuer, looking at his answers, what kind of feeling are you getting? Is the risk there or is there is no risk? Make your assessments
Yes,
by putting
right.
these questions. And yes, somebody said high risk. So we are just deciding right now that there is risk or not. Yes, it is risky. So in step number 2, when I asked him about the status of dividends, he said it is discretionary. I said, oh my God, he puts me under discretion. He may not give me a return. When I asked him about the questions pertaining to the principal repayment, he said it's going to be paid on liquidation. And that makes a decision in step number 2 that the risk is there. The risk is there. So that gives me an understanding the risk is there. I'm putting a question to the issuer, asking him the principal and the return. He gives me answer, Meri Marzi. I will give you the dividends or not, Meri Marzi. I say money on principal repayment. He says on liquidation. That also you stand last in the queue. Oh my God, risky. Then I go to the step number 3. When I go to the step number 3, now it's time for me to interact with the holder. Today, in your sleep, you're going to see me in your dreams, where I'll be standing in front of you and you'll visualize that this man is speaking to the issuer in step number 2. Then he's speaking to the holder in terms of step number 3. I'm going to ask you on Tuesday, did you see me in your dreams? You must. You must be visualizing something in your dreams today, watching me speaking to the issuer and then to the holder. I'll ask you. Okay, let's go ahead. So in step number 3, I'm now asking the holder, why did you invest in that company? I said, why did you invest in this company? What is your intention? He says, intra-trading. I said, what? He said, intra-trading. I'll buy, sell, I buy, sell, I buy, sell. So what do you say? Risk is high or the risk is less? I asked him, what is the intention? He says, I'm going to do intra-trading in that company. So do you think the risk has become high or the risk is comparatively less? Tell me. So by putting a question on this sort, when I asked him about this, he says, I put this money and I am going to do this. That's right. It is high risk indeed. Superb. I think I'm getting good answers from everybody. That's great. It is high risk. So when he says that I will do trading, that indicates it is very risky. So would you like to tell me if it is very risky, what kind of measurement model are you going to use? Let's see if you can decide that. Intra trading is what I'm going to do, very risky in nature. So would you like to decide the measurement model? ACE, OCI, PNL? ACE, PNL, or OCI? What do you think, friends? Decide. The risk is very, very risky indeed. So what model are we going to use? I think I need to answer that. FPTPL is going to be fair value through PNL. That's right. Did you get the logics now, what we are working on? Now let's change the input. I'm again speaking to the holder. He says not trading. He says the intention is not to trade. It's not trading. Is the risk slightly gone down? When I put the question to the holder, what is your intention of putting that money in the investment? He says, no, I'm not going to do trading at least. Does that dilute a level of risk slightly? I think yes. If it dilutes, would you like to decide the measurement base in this particular case? Decide, friends. So if you go with this particular case, that's right, it becomes FPTOCI. So in this particular case, the interesting part is the standard gave us a choice. The standard gave us a choice. It said that you can either use FPTPL or you can use FPTOCI, and that also NR. So they say we give you a choice. We say we give you a choice. You can either choose FPTPL or you can choose FPTOCI NR. And let me now tell you some more interesting inputs. When I say that I give you a choice between the two, so this choice is supposed to be an irrevocable option. So this choice is supposed to be an irrevocable option. Once you choose the option, you cannot go back. And please hear me carefully. I'll pen that down later, but I want to put that in your mind at this stage. Please watch me. If I use FPTPL, unrealized gains and losses will go to the P&L. Realized gain and losses will go to the P&L. I said unrealized gains and losses. Every year the fair value changes, which are unrealized will go to the P&L, and the realized gain loss goes to the P&L. So why? Exception. If you choose FPT OCI, the unrealized gains will go to the OCI and the realized gain and losses OCI. You heard me correct. I said in this case, gain, loss, realized, unrealized P&L. In this case, gain, loss, realized, unrealized OCI. Exception to the version number 2 chart. So if you choose OCI NR for equity, everything will go to the OCI. The unrealized gain loss, the realized gain loss, which means even if you sell the investment, the gain loss on sale will enter the other comprehensive income. This is the only category of, you can say, financial asset which has been carefully drafted. The standard setters wanted that if you choose FPT OCI, nothing will go to the P&L. The fair value changes every year will enter the OCI. Even if you sell the investment, it enters the OCI, which means that your EPS is never ever affected, not even on account of sale of the investment. Sir, but why? But why did the standard setters decide such an extreme situation that you're putting the money in terms of realized gain loss in OCI, unrealized gain loss in OCI? If you're putting money into the equity investments, it is not your business operation. Let me tell you that if you put money into the equity shares of a related company, which I said earlier as well, in those particular cases, I said Ind AS 109 does not apply. Ind AS 109 applies only when you put money in unrelated party investments. So if you're putting your money in equity shares of unrelated company and there is again a loss, it's not your business operation. I don't want your earning per share to be affected even if you sell the investments and realize the gain or loss. I don't care. So they decided that in terms of this choice, be careful. If the company wants that their income statement EPS should become an ECG report, then go for FPTPL. If they want that the EPS should never ever become ECG report, then you go for OCI. Ideally, if you ask me on a practical level, companies would choose FPT OCI NR. But in this particular case, the choice is given by the standard. The companies are free to make this choice and decide the category, but you know the implications which goes. From the examination point of view, we can say by default it is FPTPL. If you tell me that my company invested in equity shares of another company, I'll say by default it is FPTPL. It is only if I choose the irrevocable option of measuring the investments at FPT-OCI, then I'll apply that. So which means if it is held for trading, it is FPTPL. Even if it is not held for trading, by default it is FPTPL. But if the company consciously chooses FPT OCI, then you'll apply that category. So one thing which is important to pen down at this stage. So when you take FPTPL, so let's put the asterisk. And when you take the FPTOCI, let's put a double asterisk. So we can say that when you take FPTPL, you can say the gain, the loss, realized, unrealized, realized, unrealized, irrespective in this case, when you take FPTPL, it all goes in the profit and loss. Realized, unrealized, gain, loss, whatever. And when you say it is FPTOCI, when you say it is FPTOCI, the gain, loss, realized, unrealized is all going to be taken in the other comprehensive income. Wow. So can you just consolidate the inputs once again? Yes, I'll do. Let me. So the thoughts are very simple and straight. As a holder, I invested in the equity shares of a company. They call it as equity instrument. So what is it for me? Equity investments. In the second step, I put the questions to the issuer and ask him, are you going to pay me dividends? Discretionary, principal, liquidation. Oh, I get into a risky situation. I go back to the holder and ask him, what is your intention? Trading. Oh my God, that's very risky. FPTOCI, sorry, FPTPL. I said, okay, what is the intention? He says, not trading. I said, then you get a choice. FPTPL, FPTOCI, which is NR, your choice. If you choose FPTPL, everything in the P&L, realized gain loss, unrealized gain loss, everything in the P&L. OCI, everything in the OCI, realized gain loss, unrealized gain loss, all OCI. Let's, I think, have a look at all this agenda in that beautiful chart as well. This is my chart 1, and I want to now connect you back on the chart. Let's come back on this chart. Have a look at the inputs at this stage. So we're just going to have a look at this input at this stage. Just watch only the portion of the chart which I show you. You're going to get clarity of thoughts. So in this case, this is the step number 1. This is what I've created as step number 1. You step into the shoes of the issuer and ask yourself a question. Okay, is this an equity instrument? Then it is equity investments for me. Now see what is there. This is the step number 2. This is the step number 2. Contractual cash flows, solely payment of principal and interest. The step number 2, please hear this carefully. The step number 2 is called CCFC, comprising SPPI test. Oh my God. The step number 2 is got a test which is called CCFC, comprising SPPI test. The step number 2 which you're conducting is given a nomenclature. It's called CC, contractual cash flow, CCF. Contractual cash flow, CCF, characteristic comprising solely a payment of principal and interest, SPPI, solely payment of principal and interest. You know, when I was looking at the step number 2, I was putting a question to the issuer, are you going to give me dividend? It's like interest return. I was asking him, are you going to give me principal? He said on liquidation. The idea was to look into, are you getting the right to receive the contractual cash flow? Are you getting the right to receive the contractual cash flows, both in terms of principal and interest? And the answer is no. I was not getting a right. I was not getting a right contractually to receive the principal and the interest. So this test, as you can see, will always get failed. So then what is the need of applying the step number 2? Can I skip the step number 2 in terms of equity investments? You can. If you ask me in terms of step number 2, will you ever pass this test in terms of equity investments? No. And that's the reason that the answer is a fail. But still we are saying that the step number 2 is CCFC. Are you getting the contractual rights to receive the cash flows on account of principal and the interest on that principal? The answer is no. Then this is the step number 3. Are you doing trading? Are you doing trading? And if you say, yes, I am doing trading, you can see the red color, khatra, the danger. So when you say yes, it is held for trading, I am FVTPL, fair value through P&L trading. Very, very risky. So this is a test which is called HFT test. It is called HFT test. That's called held for trading test. So when you say HFT, held for trading test, if you say yes, it is FPTPL. If you say no, then there is an FPTOCI option. You may select the option because I said you get a choice. You get a choice. So if you say yes, I'm selecting the option, it is FPTOCI, which is no reclassification NR. And if you say no, then it is FPTPL. And this option, as I said, is an irrevocable option. This option, which I said, is an irrevocable option in this case. I think you must have now got connected with the dots in terms of chart number 1, visualization, step number 1. Step into the shoes of the issuer and say, his equity instrument is my equity investments. Step number 2, CCFC comprising SPPI test will fail. Step number 3, held for trading. And if you say yes, FPTPL. If you say no, you got a choice. FPTPL, FPTOCI, and the accounting implications of FPTPL and FPTOCI. Did you get the clarity of thoughts, friends? Is my chart number 1 100% clear? I've given you the logics as well. What is the thought process? Step 2, issuer. Step 3, holder. And that's how you decide risk assessment. This is the risk assessment test number 1. This is the risk assessment test number 2. The risk assessment test is by putting a question to the issuer. The risk assessment test is putting the question to the holder in terms of intentions. Clear with the thoughts, I guess? Okay, that's wonderful indeed. Clear on this, super. So I think that's done. Now let's come back and let's enter some technical terminologies on the chart number 1. So in this particular case, we're just going to put pen down some technical wordings at this particular stage. So we can say the step number 2 is called CCFC comprising SPPI test. This is the name of the test in step number 2, that you're going to conduct a CCFC. So let's pen down what is this. This is contractual. This is contractual cash flows characteristics. This is contractual cash flow characteristics comprising. It is comprising solely payment of principal and interest. Comprising of the principal and the interest. Wow. That is the step number 2. So we're looking at CCFC comprising solely payment of principal and interest. And in step number 3, this is step number 2, my mistake. This is step number 2, I'm afraid. Then in terms of the step number 3, it is HFT. In terms of the step number 3, it is HFT. It is called HFT test. That's called held for trading. That's called held for trading test. So this is what you need to apply in terms of the test. Wonderful. So I think my chain of thoughts is very clear. Now, based on this, I'm going to put some inputs to you. So you are very clear now with the chart. Step 1, you step into the shoes of the issuer. Step 2, CCFC SPPI test. Step 3, HFT, and then decide the inputs. Let me now make a strong statement, friends, based on our discussions, and let's see if you can say, vouch me a yes or no on this. Can I say if a company makes investment in equity shares of another company, by default, it is FPTPL. That's the crux of this chart. Agreed. If a company makes investment in equity shares of another company, by default, it is FPTPL. Agreed. And I think I should get the answers on that this is the case. I think I got the answers. Agreed. Wonderful indeed. Because if you say trading, APTPL, if you say not trading, it is still by default APTPL. APT OCI is only when the company chooses an irrevocable option. So can I say equity investments by default are going to be taken at FPTPL unless it is not held for trading and the company chooses the option of measuring it at FPT OCI. And the second important thing is, which I've already said, FPTPL means gain loss realized unrealized P&L. FPT OCI means gain loss realized unrealized all OCI. Any questions on your mind, friends, so far? Am I clear absolutely to the core on my chart number 1? Then I can start working on the chart number 2. Great, superb indeed. So I think that's wonderful indeed. We get the inputs clear on that. Great. Now let's go further. Now we are on the chart number 2. Now we are on the chart number 2, and on the chart number 2, we are looking at debt investments. We're looking at debt investments in this case. So in the chart number 2, we're looking at now the debt investments. So we said we make 3 charts. Equity investments, now we're working on the debt investments. So I think let me first of all, visualize things at this stage. We'll do the documentations later. So we'll first keep putting questions in terms of this. So 3 steps, step number 1, step number 2, step number 3, and you decide the measurement. So we're going to go with the step number 1. We're going to go with the step number 2. We're going to go with the step number 3. And then we will decide the measurement base which is to be applied based on the risk assessment which is being done. Let's put the first step to you. A company invested in a financial liability of the issuer. So the issuer says it's FL. What is it for me? Debt investments. I step into the shoes of the issuer and I say that it is a financial liability. So what is it for the holder? It is supposed to be a debt investment. It is supposed to be a debt investment in this case. Now, let's do the talkings at this stage. So in terms of the step number 2, I'm speaking to the issuer. Now you need to give me answers, friends, on that, because I'm going to put questions to the issuer in step 2, and then I'm going to put questions to the holder in terms of step 3, and you will decide the inputs. I'm now speaking to the issuer. I said, are you going to give me interest? He says mandatory. I like it. I said, are you going to give me my principal after a fixed tenure? He says, yes, I am obliged on a mandatory basis to pay the principal back. What do you feel? The risk is there or not? I asked him that, are you going to pay me interest? He says mandatory. I said, are you going to pay the principal money back after N number of years? He said, yes, mandatory. So do you think I am running a risk? Please don't assess that I'm running a risk of non-payment. That is different. If I don't get the money, it will be assessed later as an impairment. So let's not see that, he may not pay the money. That's fine. He's obliged to pay. That puts me under a contractual right to receive the money. So is there a risk or no risk in this case? That's what you need to decide. And that's right. There is no risk. No. Don't decide AC at this stage. We need to decide the level of risk later. So right now we can only say there is no risk. So my step number 2 is telling me there is no risk. Now I go to the holder and tell him, what are you going to do with this investment? He says, sir, I'm going to keep it till maturity. He says, sir, he's going to give me the interest for the next 5 years. He's going to give me the principal after 5 years. I'll keep this investment for the next 5 years. He'll keep giving me, I'll keep taking. I'm going to keep this investment till maturity in life. So does that reconfirm that there is no risk? The issuer has got obligation to pay, the holder has got the right to receive, and he's got a complete intention to keep the investments till maturity. Does that confirm that there is no risk? Yes. I put another question to him and I say, okay, second one, what is your intention? He says trading. He says trading. Huh? I said he's going to give you interest in principal. He says, I'm not interested. I'm going to do trading in this investment. Does that immediately spike up? The risk is very high. What do you say? Does it immediately increase the level of risk? Because when he says the intention is to trade, that means it becomes risky. And if it becomes risky, then you are using which one? FPTPL. When there was no risk, AC. Now, I put another question to him and I say, okay, what are you going to do? He says, I might keep it till maturity. I might sell the investment. It's my choice. Easy got somewhere in between because when it was maturity, it reconfirms no risk. When it is supposed to be, trading, it is very heavy risk. Now he says, I might keep it, I might sell it. I've got a dual objective. I might do this, I might do this. Does that mean that you're now somewhere in between a zero risk and a high risk? Yes. So which model are we going to use in this particular case? FPT-OCI. And this time the FPT-OCI is a case of R. Equity investments are the only category which is being given an R. Debt investments are given R. So let me just connect the dots. I invested in the financial liability of the issuer. I went to the issuer and said, you're going to give me interest? Yes, sir. You're going to give me principal? Yes, sir. I feel safe. I go to the holder and ask him the intentions. He says maturity, AC. He says trading, FPTPL. He says I'll trade or I'll keep it till maturity. I'm deciding FPT OCIR. Debt investments is always R. Equity investment is always NR. Did you get the connect? Did you get the dots connected in terms of how I'm going to apply my thoughts on the concept of debt investments? Great. I think it's time to give you some break now. I'm sure you need this. We'll document all this. Our third chart is still pending. We need to go and revisit that colorful chart as well to correlate all the dots. Once that becomes clear, then we start our practicals on accounting of financial assets at that stage. So please take a little minute, going through this particular chart, one which I've created, so that we can connect all the dots together. So as I said, by around 9:15 or so, you will be able to get 9:50, 9:30 in between. You'll be able to get all the dots connected very well. Right, friends. So I think time to give you a small break. So we'll take a 10, 12 minutes break at this stage, and then we start back on our working on the chart number 2. Relax your minds. Okay, thank you. Hope you had a relaxation of mind. And of course, spend a little minutes, I guess, looking at the chart number one, which we have done. Now let's come back to the chart number two. Let's document the inputs as far as the debt investments are concerned. So I guess we've already seen that the issuer says it is FL and the holder says it is a debt investment. So when you go to the step number two, you're putting a question to the issuer. So in this case, again, in the step number two, you're putting a question to the issuer and the test is the same. It is called CCFC comprising SPPI test. So there is no difference in terms of the test in step number two, whether it is equity or whether it is supposed to be debt investments, it remains the same. You're putting the question to the issuer, are you going to give my interest? Are you going to give my principal? And undoubtedly, this test will pass. And if this test pass, can I say that would mean that there is no risk per se. But then you need to decide on the basis of step number three by looking at things now from the holder's point of view and deciding that there is no risk or is there a risk. Now the test undergoes a change. In step number three, in terms of equity, we said it is HFT, held for trading. But in this particular case, the name of the test undergoes a change and it is called a BM test. It is called a BM test. That's called business model test. That's called a business model test. In other words, it is looking at the intention. In other words, it is looking at the intention of the holder. What does he intend to do with that particular investment? Is it to hold it till maturity? Is it to trade, or maybe a mix of the two? So in this case, the business model could be in terms of three inputs, we can say. The business model could be either to keep the investments till maturity, or it is supposed to be doing a trading, or we can say there is a mixed case that means either maturity or trading. Now, when you say it is still maturity, then it confirms no risk, then it is amortized cost. If it is trading, there is high risk, it is FPTPL. And if you say it's a mix, it is supposed to be FPTOCI, and this is reclassification R. Remember, in terms of debt investments, it is always R. In terms of equity investments, it is always NR. The concept is OCI, but debt investments is R, and the equity investment is NR. And I think at this stage, it is now also important to tell you one more thing. In terms of this FPTOCI, now watch this carefully. Unrealized gains or loss in the OCI, realized gain or loss in the P&L. Oh my God. So in this case, when you say it is unrealized gain or loss, it is unrealized gain or loss, we're going to park this in other comprehensive income. But when you say it is realized gain or loss, the exception does not apply. The realized gain or loss is going to be taken in the P&L in this case. So you need to appreciate one thing. In terms of equity investments and in terms of debt investments, the concept is slightly different. In terms of equity, number one, it is NR. In terms of debt, it is R. In terms of debt investments, it is supposed to be unrealized gain loss OCI, realized gain loss P&L. In terms of equity, realized unrealized gain loss, all in the OCI. That there are two main distinguishing features. That debt comes with R, equity comes with NR. As far as debt is concerned, the difference is realized gains or losses are captured in different places. But in terms of equity, realized gain, unrealized gain loss, everything gets captured in the OCI. In terms of equity, nothing enters the P&L. In terms of debt, only the realized gain loss enters the P&L, unrealized enters the OCI. I hope I stand absolutely clear on that particular front. So this is the inputs in terms of the chart number two. Getting the insights in terms of how a debt investment, which is in a FL, is recorded in the books of the holder. Let's get back to the chart. Let's go back to the chart and let's have a look further on that chart once again. So we're just going to look at the chart once again and let's see the debt investments in this case. Let's have a look at this. Now we're looking at the left-hand side in terms of understanding. So this is, I would say, a step number one. That what is FL or what is CFI for the issuer becomes a debt investment. We're yet to see the case of CFI. We're only looking at right now that it is FL for the issuer and it's a debt investment for the holder. We'll see CFI chart 3. So you can see the test is passing. The test is passing in this case. So this is the same step number 2. We're looking at the CCFC comprising SPPI. It passes. And this is the step number 3, looking at a business model, the intention. Is it to collect contractual cash flow, which is like maturity? If the idea is to collect the contractual cash flows, which is basically maturity, then you can see it is AC. Though you can see somewhere the option given. We'll see that later. Then it says it is to collect the contractual cash flows and also to sell. It's like a mixed model in this case. We might keep it till maturity or we may sell. And in this particular case, it is FPT OCI with R. And if it is neither means it is held for trading. You go to basically do trading, then it is FPTPL. So you can see that this entire chart on the left-hand side is devoted to debt investments. Right-hand side is devoted to equity investments. And let me now also tell you, if you're falling under AC or if you're falling under FPT OCIR, the standard also gives you an option to go for FPTPL. But this is not an option which is by choice. The choice between AC FPTPL in terms of debt or the choice between FPT OCI and FPTPL is not an open choice. It is supposed to be selected on the basis of certain parameters. And that parameter is called, don't worry, we'll document that later, that parameter is called elimination or reducing the accounting mismatch. This option given out here is a free choice. This option given out here is a free choice, but this option given out here is not a free choice. If you're looking at a debt investments ACA or FPT-OCI and you plan to take them at FPTPL, it's not a free choice. It is supposed to be a choice which is based on what is called elimination or reducing the accounting mismatch. Now, what is this eliminating and reducing accounting mismatch? We'll see later. We'll see later, but this is something which we can say is a conditional choice. This is something which we can say is a conditional choice, and this is what I can say is a free choice. Here you can decide to consider the either of the two. It's a free choice, but in this particular case, it is supposed to be a conditional choice. Moral of the story. I think let's say something to you, and maybe you can vouch me at this particular stage. So can I say if a company makes a debt investment, if a company makes a debt investment, can I say it all depends upon the business model? Equity investments by default is FPTPL, but can I say debt investment is all based on the intentions, maturity AC, and if it is mixed OCI, and if it is trading FPTPL. Is my thoughts correct? Is my thoughts correct that in terms of debt investments, business model intention is the deciding factor. Maturity means AC, trading means FPTPL, dual model means FPT OCI. Clear? Great. So this gives me my thoughts in this particular case. Now I think let's go further. The chart number 1 is done. The chart number 2 is done. The third chart, which is now on the CFI. So let's, I think, get back and let's go to the chart number 3. We'll talk about those derivatives later. I'll just spend that. That's not coming as a separate chart. So let me just add a chart number 3 at this stage. So we're looking at the chart number 3. And this chart number 3 is supposed to be, you can say, debt investments again. But these debt investments are when you're putting money in CFI. So what is a CFI? For the issuer becomes a debt, for the holder, issuer becomes a debt investment for the holder. And there is nothing beyond these particular charts. I'm not making a derivative investment chart because you'll see that it's pretty simple and straight. So mainly 3 charts. Equity instrument, equity investments, chart 1. FL, debt investments, chart 2. CFI, debt investments, that is chart 3. Now let's see again in terms of the 3 charts. Now this is simple. Here the standard setters have made a life a little simpler when you look at a CFI. So let's run this again in terms of the 3-step model. So this is my step number 1. This is my step number 2. This is my step number 3. And we are looking at the measurement base in this case. So here we're looking at those debt investments which are a CFI for the issuer and becomes a debt investment for the holder. So when you step into the shoes of the issuer, we say it is a CFI. So from the holder's point of view, it becomes a case of debt investments. It becomes a case of debt investments. And trust me, the step number 2 remains the same. Looking at things from the issuer, asking a question to the issuer, the step 3 is the same, asking a question to the holder and then deciding. Now, watch this carefully, because now you're going to see something very interesting in terms of the interpretation in step number 2. So we're again putting a question to the issuer. The test remains the same. The test remains the same. It is CCFC comprising SPPI test. What if I tell you that this test will fail? So, but why would it fail? Now, please hear me carefully, answer this very carefully, analyze the sentence and answer me. Generally, I'm saying generally, when you put money in optionally convertible debenture, it is CFI. A company issued optionally convertible instrument, that is a CFI. So are they going to give me solely? Are they going to give me solely the payment of interest and principal in cash, or they may pay me in shares or cash? Tell me. Because you're saying it's a contractual cash flow. You should be getting the principal interest solely in cash. Are you going to get payments of principal interest solely in cash, or maybe in principal, maybe in terms of shares or cash, because the holder may decide the option? Is that correct? Is my thought correct? That when you're looking in terms of optionally convertible instrument, the issuer may land up giving shares to the holder. The issuer may land up giving cash to the holder. So can I say in this case, is the cash flow solely in terms of principal interest in cash, or partly maybe shares, partly maybe cash? What do you say? And that's right. So in this particular case, because of that word solely, you can say this test will fail, and the standard says if this test fails, no assessment in step 3. I'm not even going to look at the question from the holder's perspective. They say that if this test fails, it is very risky, and therefore it is FTTPL. Finish. We're not even applying the parameters of step number 3. We're not even looking at the business model in this case. You make investment in a particular security, which is a CFI for the issuer, that is considered to be risky, and there is no further questions, and it is FPTPL done. So I think moral of the story now, I want to say some thoughts at this stage. You need to vouch me on my thoughts. I'm now first going to go back on the chart, and then I'm going to make some statements to you based on the observations, and you will vouch me on that. Let's come back on the chart again. So you can see that the CCFC is failing. This is going to fail in terms of CFI. This is going to fail in terms of CFI. Can you see no further questions asked directly FPTPL? That is the place where it'll fail. Equity investment done, debt investments FL done, debt investments CFI done. And the fourth one is derivative investments. If you put money in derivative instruments, risky? Very risky, you tell me. You enter into contracts which are derivative in nature, forwards, futures, options, swaps. Do you think the nature itself is risky, very risky? So if they're very risky in nature, then no questions asked. Can you see derivative investments again fail? Directly goes in FPTPL. I'm now going to make four statements to you. You need to vouch me. Then I'll make a summary chart of all the four inputs put together, and I'll give you a concrete summary on that. But let me first make four statements. Let's get ready. I think I've not asked many questions today as well. Let me now ask four questions to you. I make an investment in equity shares of another company called an equity investments for me. Can I say FPTPL by default? Yes or no? I make equity investments in equity shares of the company. And can I say in this particular case, it is supposed to be FVTPL by default? That's correct. So I got just one answer on that. I was thinking I'm going to get flooded answers on that. I said, you make investment in equity shares of another company. So it is equity investments, FPTPL by default. That's right. Next. Can I say I've got derivative investments? Can I say FPTPL by default? I make a derivative investments and that makes it FPTPL. That's right. Next. Can I say I have got, let's say, debt investments in CFI, FPTPL by default? I've got debt investments in CFI. That is also supposed to be FPTPL. Great. So equity investments, FPTPL, debt investments, CFI, FPTPL, derivative investments, FPTPL. Aha. Number four. Can I say if I've got debt investments in FL, depends upon the business model, maturity, AC, trading, FPTPL, mix one, FPT, OCIR. Agreed. I think yes. I didn't get much yeses on that. Actually, I think people are getting a little tired on all the data coming to you. So level is increasing every class? Yes. Will it further increase? Yes. But you should be able to get the dots connected. That's more important indeed. Yes. Wonderful indeed. So I think I'm now going to make a complete pen chart, which is going to give you summary of all the inputs of all the four permutation combinations, and then we can proceed further. So let's, I think, add another summary chart, which is going to pen down all the four permutations combinations from a financial asset point of view. So I am now making a chart which will pen down the measurement base for financial assets initially and subsequently based on a three-step model understanding, a quick summary chart, a quick mind map at this stage. So I am getting my thoughts very clear, summary chart. And we are looking at the financial assets. We're looking at the financial assets measurement. So we're looking at the financial assets measurement, and we need to still now do practical illustrations, understanding the concept large. Okay. So in this particular case, I would divide my discussions in terms of two parts, because whenever I look at measurements, as I said earlier, I start looking at measurement that is initial. I start looking at measurement that is subsequent. So we're looking at the initial and the subsequent measurements both. Initial measurements, we said, is at fair value. Initial measurement is at a fair value with the two exceptions I've already given. So I've already given you that there are two exceptions. where instead of the fair value, we use the concept of a transaction price. And one is called a trade receivable, and one is a loan, which is recoverable on demand. I penned this down earlier as well. So initial recognition is going to be at a fair value. Now, it's time to add on something more to you, friends, at this stage, which is going to be our next area of discussions coming in the next session as well. So can there be a difference between a transaction price and a fair value? Yes. If your financial asset is initially captured at a fair value and the transaction price is different as compared to fair value, how do you account for the difference at time zero? That's going to be our next area of discussion, the branch going in between. As I said, when we're discussing the accounting of financial assets, there will be some internal branches of discussion. So at this stage, I would like to pen down the thoughts that since the initial recognition is at a fair value, so the question arises, if the fair value versus the transaction price, there is a difference. How to treat that difference. So we need to see how we are going to treat that difference. So that is our discussion at a later stage. But you need to keep this in mind that initial recognition at a fair value other than a transaction price could also lead to differences which needs to be accounted for. So this is going to be a special issue discussion in this case. That when financial assets are initially measured at a fair value and there is a difference in TP, transaction price and fair value, how do you account for the difference? We'll do extensive discussions on that. And this is a hot favorite area from an examination point of view. You're going to see that examiner asks a lot of questions on this area. Invariably, he'll keep putting questions to you that the fair value is different, the transaction price is different, and how do you tackle the difference? So that's going to be a separate area of discussion for me. Now, let's come back on the subsequent measurement. So we said that this depends upon the three-step model which I gave you. But if you look at the inputs in terms of the three-step model, I would divide this in terms of four parts. I would say it is either equity investments. I would say it is either a debt investments, which is in a compound financial instrument, or I would say it is a debt investments. I would say it is a debt investment which is in a financial liability, or I would say it is supposed to be a derivative investment. That is the essence. That is the essence in terms of the three-step model. It's either equity investments, or it is debt investments in CFI, or it is debt investments in FL, or it is derivative investments. So when you say it is equity investments, we can say in this particular case by default. We can say in this particular case by default, it is going to be FPTPL by default. I didn't say always. I said by default, it is FPTPL. But can I say in this particular case, if it is not for trading, if you say that it is not for trading, then you get a choice. Is that an optional choice or is it a conditional choice? Let me ask you. So when you say that it is not held for trading, is it a free choice or is it a conditional choice in this particular case? And this is, of course, a free choice. That's right. So if it is not for trading, we get a free choice in this case. And the free choice is that either you consider FPTPL or you consider FPTOCI, but is always NR. This is as far as equity investments are concerned. Now, when you look at the debt investment CFI, can I say always FPTPL? Can I say it's going to be always? Or let's, I think, not say always, could be dangerous. Let's, I think, put it as generally. Not even default, I'm saying generally FPTPL, because you'll fail that solely test. because there are other instruments which are CFI, not only optionally convertible instruments, but there can be other instruments. So it is preferable to say generally it is FPTPL. And if it is a derivative investments, can I say it is always FPTPL? In this case, it is always FPTPL. So you can say equity by default FPTPL, derivative is always FPTPL, and CFI is generally FPTPL. And in terms of the debt investment, it depends upon business model. So I think I can put that in the next chart. So this is summarizing our entire discussions, our understanding, but there are more charts coming in, which will give you more clarity of thought in terms of doing the practical illustrations as well, but not at this stage. So let's, I think, now add on that depends. So when I say that it depends, I want to now see that when you say debt investments, financial liability depends, we can say it depends upon the intention. It depends upon the intention in this case. So we can say the intention is the business model. The intention is supposed to be the business model test. So we can say there are three things. One is you say that I'm going to hold it till maturity. One is you say that we're going to do a mixed model. And one is you say that we're going to go for a trading in this case. Now, when you say it is maturity, can I say it is amortized cost? When you say mix, it is FBTOCI, and that is always R. Debt is always R. And when you say trading, it is FPTPL. If you go to AC or if you go to OCI, is there a free choice or conditional choice to take FPTPL? Let's get this from you. So when you consider in this particular case, it is maturity and mix. When you consider maturity and mix, so in this particular case, we are getting a choice. So is that a free choice or conditional? Wonderful indeed. So we can say in this case, there is a conditional choice. There is a conditional choice in this case. And that conditional choice is that we can take FPTPL. And what are the conditions? Can I say the conditions is that we need to reduce the accounting mismatch. Now, what is this accounting mismatch? We have to yet to see. But we need to prove that this will reduce the accounting mismatch. So if the company can prove that the accounting mismatch is getting eliminated, not eliminated, I would say reduction, then only I can use this. So this is a conditional choice. It's not a free choice, unlike equity. Wow. There's another interesting chart which is coming to my mind. Shall I give it to you? I know I must have tied you to the core, but I said, almost till around 9:30, you'll be very clear with the chart. I guess you are. There's another interesting chart giving you a classical difference between a debt investments, equity investments, OCI category. What is the areas of differences which can help you in getting the MCQs absolutely clear? You need to ask for it, then I give it to you. If you ask, I give it to you. Majority says yes, I give it to you. I've tired everybody so much. Okay, I just get one input, so please give it. I think everybody is all gone drain. It's getting heavier, but it's getting interesting to me. I get finally another input as well. Okay, so let's see if we're getting some more requests in order to give the chart. Yes, I'll give the chart, no worry. So let me just add another inputs, which will give you clarity of thought. Now, whatever discussions we have done today, friends, you need to revise. As I said, the initial 4 sessions which we did, in those particular cases, of course, you did your cumulative revisions. Now, since we've started India's 109, it's now going to be very, very important that now you start doing cumulative revisions, at least this session's onward. Because all my core practical illustrations is going to be based on this particular larger concept. So I am making another, you can say, mind map. It's another small little mind map which is going to compare the two categories very carefully. So wherein you're going to compare the two categories very carefully, I think let's put that questions to you. If you can answer this, then your fundas are going super duper. So I am looking at FVTOCI, that is R, and I'm looking at FPTOCI, that is NR. So we're looking at that it is applicable to which? It is applicable to which? So R is applicable to debt or equity, and NR is applicable to debt or equity. I think you know this. Let's get some answers. Now let's do some interactions and let's get some answers. So when you're looking at FPT OCI, R applicable to debt or applicable to equity? The concept of R applicable to debt or applicable to equity? And that's right. This is applicable only to debt investments, not equity. And this is applicable to the equity investments. The very concept of NR applies to equity. The very concept of R applies to debt. Wow. Next. The second concept is that if there is an unrealized gain, if there is an unrealized gain or there is an unrealized loss, where are you going to take it in OCI? R. If you've got unrealized gain or loss, where are you going to capture that in terms of OCI? R. Can I say OCI? And where does it get captured in case of NR? Again, OCI. So next, consider the next one, and that is we are considering realized gain or loss. Now we are considering that there is a realized gain or loss in this particular case. Would you like to tell me where does it go in terms of R? Now there is a realized gain or loss in terms of debt investments. P&L, OCI. And I think we get some answers on that. And that's right. So this is going to enter the P&L in this case. And what about the NR OCI? I think that will give you a clear-cut distinction in terms of where is it going to be parked. Then also, I think let's add another point of difference as well. Number 4. Can I say the accumulated balance in tab 3? The accumulated balance in tab 3 in terms of R will be taken where? Can I say P&L? And this will be transferred to tab number 2 at the end. Is that correct? In terms of retained earnings, right? So I think that gives us a complete inputs. And let's also give you another area of difference as well. So in terms of equity and in terms of debt, can I say in terms of equity, FPTPL and FPTOCI, that is NR, is a free choice, is supposed to be a free choice. But can I say in terms of debt, FPTPL or FPTOCI, that is R, is supposed to be conditional choice. That is supposed to be a conditional choice. So this is, the distinction between the two categories, equity and debt. This is going to give you more power to understand the concepts more clear. The thought process of the standard setters, I penned them down all in the form of chart. So you need to be clear that R and R applies in which case? Debt equity. You need to be clear that unrealized gains and losses are captured at which places. You need to be clear what is the treatment of the accumulated balances in the tab number 3. And you need to be clear that where the choices are conditional and where is it free choice in nature. So this gives me the entire conceptual framework on the financial assets initial and the subsequent measurement. Now let's get your scores, friends, at this. Then I'm going to discuss the next area, that is conditional choice. So we get started on the practicals as well. So on a scale of 10, what is your conceptual understanding on the financial assets initial subsequent measurement basis to be decided. Let's get the scores. Okay, so 9 we get the score, 9 we get the score. Wonderful indeed. I think that's pretty good. But my request, I insist that please make your revisions. I insist, and as I said, please make your revisions in this particular case. Because once you're going to make a complete revision of all this particular deal, you are going to get a conceptual clarity of thought. Because the 3 steps will help you to finely tune yourself in the mind. That which categories are equity, which categories are debt investments measured at which base, what questions are to be put across to the issuer and the holder to take a decision. Getting heavier? Ready for some another extra dosage as well? Say yes. It's getting heavier, right? So I now need to give you some more insights as well. I need to give you now the insights on this conditional choice. When do you say that I am able to reduce or eliminate the accounting mismatch in this case? Yes, getting heavier. That's great. So we have got another piece of information to discuss. Now, let me tell you in advance how I am going to proceed with the accounting fundamentals in this case. I'll just give you a chain of thought so that you're absolutely in tune with the way we are discussing things. So let me just give you a chain of thought. It's important to keep giving you a chain of thought how I want you to think. How I want you to think as we now proceed. Our focus has been on the financial asset accounting. Our focus has been on the financial asset accounting. Now, how are we going to proceed in this case? Just watch this. So my focus is on the accounting in terms of financial assets. So we know that its initial measurement is going to be at a fair value. But what do we need to cover in this particular case? What I need to cover in this particular case, we need to cover one special issue. We need to cover a special issue out here. So this is going to be one area of discussion. And what is that area of discussion? When the fair value is not equal to the transaction price, we need to see how to account for this difference. How to account for this difference. So this is one area which is going to be a special issue. So we'll spend a good time on this area. That's one special issue which we need to enter into. The second is when you're looking at financial assets on a subsequent measurement. When you're looking at accounting on a subsequent measurement, we said that you will end up taking either saying that it's equity investments, which are either measured at FVTPL or they are measured at FVTOCI, that is NR. Or we can say that we've got debt investments. We've got debt investments, and these debt investments are either at AC or it is FVTOCI, that is R, or it is FVTPL. So you need to be very clear with reference to the 5 categories of investments. You need to be very clear. So we're going to do, you can say, 5 questions out here. We'll do 5 questions out here. I will tell you how the accounting for debt investments at AC, which we've done almost, how the accounting for debt investments OCI and debt investment FVTPL is done. So we'll do 3 questions on debt investments. How the accounting for AC, how the accounting for OCI are, how the accounting for FVTPL is done. And we'll do 2 cases in terms of equity, how the accounting for equity, FVTPL and OCI NR is done. So 5 questions on that. And then there is a special issue here as well. So in this particular case, there is a special issue here as well. So here we need to cover a special issue. So we need to cover that special issue. And what is that special issue? The special issue which we need to cover is that when we can apply FVTPL. when we can apply FPTPL. So this is what we need to decide, when you can apply an FPTPL. And this is the condition. You need to decide the condition that it will reduce the accounting mismatch. So your mind has to be now tuned in terms of this kind of a thought process. How you want to think, how you have to think is what I'm telling you, because you need to be very clear in terms of thoughts that, okay, financial assets are taken at a fair value, but there is a special issue that if the fair value and the transaction price differs, how do we account for it? So this is one special issue of coverage to be done. Subsequently, it is based on these 5 types of categories. We'll see the accounting initial to subsequent for all those 5 categories. And there is a special issue that in terms of this AC OCI, when can you use an FPTPL, which is a conditional choice. I hope you're very well connected with this. If the need be, friends, watch this class again. It's going to be on the YouTube, so watch this class again. Get yourself connected very well on this, because you need to be crystal clear. Maybe you can watch this at a higher speed, 1.5x. But put yourself, just watch this, understand this, because you got, 2 days in between, Sunday, Monday. So on a Tuesday, you're absolutely in grip with the things. Okay, so far so good. I hope this helps. The understanding of the chain of thought helps. Now, we need to go further. And we need to cover this special issue right now. Let's, I think, now take you to a wonderful illustration in the study material. So I'm going to take you to a wonderful illustration in the study material as well. I'm just eliminating this so we can just come back to the illustration what we need. So this will be all later. This is going to be later. Okay, I think we can just have a look at this chart as well. This is again a wonderful chart. I'll be making something similar to you in the next class after the practicals are done. But I think it's a good idea looking at this interesting chart. Some very interesting piece of information, charts that have been done in the study material. So I think let's have a little look at this chart as well. We've already covered this indirectly, conceptually, but we'll just still like to, go through this before we come to the accounting mismatch. So we can see the measurement of financial assets, and there is initial and there is subsequent. Initial measurement, it says, is at fair value. I'm not reading anything further. And let's see the subsequent, it's either AC or it is FPTPL or FPTOCI. And in this particular case, it says, I'm not reading this part, I'm just coming to this part. It says for FPTPL and OCI debt investments, the interest and dividend goes in P&L, the gain losses recorded in the P&L. For OCI, the dividends gets recorded in the P&L, but the gain loss goes in OCI. So you can see that in terms of FPTPL, though I segregated realized and unrealized as well. So when it says the gain loss goes in P&L, this is realized gain loss. And when it comes to equity, the realized gain loss in OCI. So it says that if it is AC, the dividend interest goes in P&L, the gain loss goes in P&L. So we'll be paring this down later as well. In terms of AC, unrealized gains loss never captured, because we don't capture fair value adjustments. Realized gain loss goes in the P&L. In terms of OCI, that is NR, you can say the unrealized gain, realized gain, everything goes in the OCI. If it is debt investments OCIR, then it is unrealized OCI, realized is P&L. And if it is FPTPL, realized, unrealized, all in the P&L. Dividends interest in these cases on debt equity is always P&L, irrespective of the category. If you've got any interest income, if you've got any dividend income, whether it is AC, OCI, R, NR, whatever, everything is on the P&L. It's only the unrealized gains and losses and realized gains and losses which needs a little, careful attention. But don't worry, we'll pen this down later when we come to practical illustrations. Now I want to work upon my inputs on the concept of accounting mismatch. Let me just come, where is the accounting mismatch? Just a second, I think I'll have to just go out here and see. This is AC. This is the loan, not this one. Let me just locate. There is a illustration in the study which is indicating this. Yes, I got it. I got it. Let me just concentrate out here on this one. Illustration number 30. Let me just remove these extra slides. Just give me a minute. This will just unnecessarily create a confusion. Illustration number 30. Oh my God. I just eliminated the illustration number 30 itself. That's what happens in a spree. Let me see if I can undo. No, I can't even do undo on this. No problems. I think I'll share it on the screen. I'll just share that on the screen itself. No worries. So we'll probably just share it on the screen. Just give me a second. So I'm just going to take you to the study material. It's unit number 2. And in the unit number 2, we've got this particular illustration number 30. Now, was this illustration carefully? It's a little technical one, but I'll explain this. No worries on that. Yes. So I'm sharing this on the screen. Let's have a read on this. Now, as I read this question, it might sound a bit technical as well, but don't get worried. I'll illustrate and explain this to you. Just hear this carefully. It says in illustration number 30, it says an entity is about to purchase a portfolio of fixed rate assets that will be financed by fixed rate debenture. Though we'll be able to get this understanding better once we cover the financial liability, but I still want to give you some idea. Maybe we can revisit this illustration later. It says an entity is about to purchase a portfolio of fixed rate assets financed by fixed rate debenture. Both the financial assets and the financial liability are subject to the same interest rate risk that gives rise to opposite changes in fair value and tends to offset each other. Provide your comments. Now, don't get worried. Let me just bring you back on the board, and I think let's have a little discussion. Now, watch this very carefully. I'm explaining you the concept of reducing the accounting mismatch. We're yet to discuss the concept of financial liabilities, but let me tell you something in advance. When you look at the concept of financial liabilities are either measured at amortized cost or they are measured at FPTPL. There is no concept of FPTOCI applicable to financial liabilities. So just keep that fact in mind, that financial liabilities are either measured at AC or they are measured at FPTPL. There is no concept of FPTOCI. So there is no concept of FPTOCI as far as financial liabilities are concerned. And we've already seen that in terms of financial assets, it is either measured at AC or it is measured at FPTOCI or it is measured at FPTPL. Now, my main focus is these two, not FPTPL, because you get a choice of taking FPTPL in terms of AC or OCI. Now, watch this carefully. If I use the concept of AC, will you capture the fair value changes? No. If you take OCI, will you capture the fair value changes? Yes. And where will they go? OCI. So remember, when you consider the concept of AC, the fair value changes are not captured. And if you consider FPT OCI, the fair value changes are taken in the OCI. Not just imagine that you land up recording a financial liability at FPTPL. Let's imagine you land up recording a financial liability at FPTPL. So where will the fair value changes go? It will enter the P&L. Now let's not talk of AC. The financial liabilities are decided to be FPTPL. The financial assets are decided either at AC or at FPT OCI. Now, in this question, it said the company invested in fixed rate assets financed by fixed rate debenture. The assets and liabilities are related. The company invested in fixed rate debenture, and this is fixed rate assets, and this is by financing fixed rate debenture. So the liability is related to the financial assets. Now, there is one thing which you need to appreciate in this particular case. If the fair value of the asset goes up, then in this case, you book the gain in the OCI. And in this case, you do not book anything. If the fair value goes down, you don't book anything, but you book the loss in the OCI. And in this particular case, if the fair value goes up, you will book the loss in the P&L. You'll book the loss in the P&L. Because for assets, if the fair value goes up, it's a gain. And if the fair value goes down, it's a loss. But for a liability, if the fair value goes up, it's a loss. And if the liability value, fair value goes down, then it's a gain. And that will also capture the P&L. So get this very clear. So what we are saying in this particular case is that if you categorize a liability at FPTPL, the gain loss on the liability will enter the P&L. But remember, for assets, if the fair value goes up, it's a gain. And if the fair value goes down, it's a loss. But for liability, when the fair value goes up, it's a loss. A gain on the asset is a loss on the liability. Mind it, a gain on the asset is a loss on a liability. So in this particular case, this gain is getting parked in the OCI, or it is not getting captured, and the loss is getting captured in the P&L. If I designate these assets at FPTPL, if I designate means I decide that I am going to call them as FPTPL. I'm going to categorize them, the accounting as FPTPL. So if you designate these assets at AC or at OCI at FPTPL, so what will happen? The gain will go to the P&L. When the fair value goes up, the loss will enter the P&L. So what will happen? The gain and the loss will get offset. The loss and the gain will get offset. So when the gain and the loss will get offset, my impact on the profitability will decrease. So can you come again? In terms of what you're saying? So let me put the thoughts once again. I'll give you the inputs very carefully. Apply. A financial asset is taken at AC. You do not capture the fair value gains and loss. A financial asset is taken at FPT OCI. You capture the gain loss in the OCI. Let's say a financial liability is captured at FPTPL. So you take the gain loss in the P&L. Now, if the asset and liability is related, you invested in the assets by financing through liability. The asset liability related. Now, the problem is in terms of liability, the fair value gain loss goes in the P&L. In terms of asset, either it is not getting captured or it is going to the OCI. So if the fair value change is not getting captured in the asset, but you're capturing it in the P&L takes a hit. If the gain loss is getting recorded in the FA in OCI, but in terms of liability it is getting captured in the P&L, dangerous again. because the gain here, the loss here, the loss here, the gain here. So the company feels that if the assets and liabilities are related, why not do something like this? Let's take the fair value changes of the asset in the P&L. Let's take the fair value changes of the liability in P&L. So the gain here and the loss here, P&L offset. The loss here, the gain here, offset in the P&L. So which means the standard setters decided that the company can decide to designate. We use the word designate. The company will decide to designate the financial assets at FPTPL in spite it falls in the AC, in spite it falls in the OCI, but we designate them to be measured at FPTPL. Reason? Because I want that the gain or loss on the asset and the loss or gain on the liability gives you an offsetting advantage. If it gives you an offsetting advantage, so what will happen? The volatility in the profit and loss will reduce. So if the company wants to take financial asset AC at FPTPL, financial asset FPT OCI at FPTPL, it needs to decide that by designating the assets at FPTPL, it will offset the gain or loss arising on account of liabilities. So that is the condition which you need to meet. You need to first of all prove that the assets liability are related, and therefore by putting the gain losses in the P&L, you get the offsetting advantage in this case. Did I make sense, friends? Did you get the understanding of what I said? I know it is very, very technical indeed. I understand, I appreciate it is pretty much technical indeed. Yes, but I think I must have made some sense. Don't worry, we'll be working upon this again later. But I think just to go back on the inputs, just to go back on the dots out here, so we can see that now we have covered this special issue. We'll also again come back on this particular issue. Now, my next journey is going to start in the next session, where I'm going to first cover these 5 questions with you. And then I'm also going to cover the special issue when there is a difference between a transaction price and a fair value. How do you tackle that part as well? Nothing more today. I think the mind must have got pretty much heavy indeed. But my sincere request, friends, please do take out time to revise all what we've done today, because this is the grounding framework on which I am going to take my Indus 109 further. Over to you for any questions on your side, friends. There will be a complete pin drop silence, I guess, now. Okay, I think that seems to be quite good for the day. Any questions on your side, friends? Otherwise, I think I don't want to take the next 5 minutes. I know we've got another 5 minutes or so, but I think if that's got very heavy, I think let's call it a day. No questions further, I guess. Nobody's friends. So I think time to bid goodbye to you. So see you in the next class with your revisions on. We're going to make some mind maps as we start on Tuesday, but please make your revisions. Thank you very much. See you in the next class. Bye-bye and take care. Maybe next time. Yes. Right, friends. Thank you very much. Bye-bye and take care. Haji, thank you. Thank you. Thank you.